So if you're buying and holding, right, you can hold it until $130. Where the $130 come up? It's from our table. So this is 130. So highest hold price. So we hold it. It might take 1-2 years to get it there, or maybe much faster. Like if we saw it's already can go to $120, and it would be up to 45% of profit plus some dividends. Now, if you're not spending too much time on investing and you want to find secure investment, Disneyland would be one of these companies. So the next one, buy and sell using technical analysis. And now you look at it, for example, if you buy it at $88 or 90 and sell it at 96, 98, you can get up to 10% on a roll. And it might take only a week or 2 weeks to do that. But if you just buying and selling, make sure to use trader's approach. So what is going to happen if the share price is going to go down? If you're happy to hold this position forever, like I mean, until it goes back to 70 and up, so that's fine. But if you're going to trade short period of time, so put stop losses. Okay, if it goes to 88 and then you can see it's broke the bottom support line and it's continued to go down, have a stop loss there to protect your downside. Okay. Another opportunity, and we discussed it last night, it's buying leap. So when you're buying, if you don't want to tie it up $90 and you want to have this company for long term, instead of that, you might buy leap call option. Now, it gives you higher profit, but remember, it's always comes with a higher risk. Because if you buy a long call, for example, until January 2019, we're going to have a look at this now, uh, you might make like up to 400% or 300% profit, but at the same time, you will have higher risk. Okay, and we are going to see it now. And you always have to consider. Now, I will never ever put more than 10% of my capital in leap calls. Never. Why? Because if I have 100% capital, 10% is in here, and I lose half of it because it's really easy to lose half of it if it goes against you. Okay, so I will lose $5,000. I know that I can get $5,000 by selling calls only a month. So I know that by investing 10% in LIPS, I can get half of it by renting shares, by selling covered calls during next month. So that's how I protect myself. Okay, because the most important part in every investment is not to lose money. Okay, so next one, buy shares at support and sell covered calls at resistance. Okay, it's similar strategy which we discussed at our program, education program, and that's where you always get it at support, be patient. So, and it's again, it would be about 88, $90. It's somewhere now, okay, and you can get there. If it doesn't go below $92, which is now, so it means that's found good support. So then you can enter the position and you can sell when it goes to around $96 and sell call. Okay. If you want to combine any of this strategy, you can, for example, want to buy and hold the position, but while you're holding, you also want to generate some type of rental income. Remember, in this case, sell calls only at resistance. So on each roll, on a high, and always sell out the money. So it's above the price, current price at that particular moment. Okay. Now, for other people who use naked puts, first of all, you can use naked puts to buy this share. So, for example, you want to set an order and to buy it at $90. Okay, that would be a target. So sell $90 put. We're going to have a look at this now. And if you buy it then at 90, it would be even cheaper because you got some premium on the top of that as well. Okay, or maybe you get some income without even buying any shares. So if share never goes below $90, you keep your money which you received when you were selling puts. Now let's have a look at option chain. So with buying and selling, I think it's pretty straightforward and easily to understand. Okay, now let's have a look. Disneyland. I took this screenshot on I think Saturday, but in any way, so it's probably the same type of returns, and it's until October 21st. So it's what? It's specifically 30 days. Today is 20th, So it's 30 days left, 31. Okay, that's what we can expect. So if we buy shares at 29.57, which is now, and we sell straight away the call, last trading price was 180. So 1.8 divided by 92.5, it's 1.9%. Okay, so if you buy shares and rent them at the money. Now, of course, we looked at this. I would prefer to set an order and buy them lower if it breaks through, okay? And we can get it at $88, right? So we buy them cheaper. And then when it moves back up, then we sell the call, okay? And we might get more than $1.75. And in this particular case, your return will be higher than right now. Okay, so that's clear. Another thing for put option, so puts on the right hand side. So that's what I was saying. For example, if you decided to buy shares at $90, but you think it might go there, it might not go there, but I'm happy to buy them at $90. So what you do, you just sell. Instead of setting the limit order to buy the shares at $90, you can set, okay, I sell a put for 83 cents. So you get 83 cents, not that much, it's less than 1%, right? But if the share price drops below 90, it's going to be triggered. Like if it stays until third Friday, you will buy it. Your buying price would be $90 minus 83 cents. So it would be $89.17. That would be a purchasing price, better than $90. Okay, but if it never goes below $90, you probably will keep this money. So you will generate nearly 1% without buying any shares. Okay, that's kind of a thing. Can you put please green tick if you understand how it works with puts, and cross if you don't? Okay, okay, all right. I'll explain one more time.